Fees, fees, and more fees. You know, Dave Ramsey and all the gurus out there, they say that whole life insurance, that specially designed whole life, it's burdened with fees. You got this cost of insurance, high commissions, and all these things. And you know what? In today's video, what I want to do is I want to talk about fees. I want to get transparent about fees. I want to ask you whether or not the fees that come along with doing the infinite banking concept and getting a specially designed whole life, do they make sense in comparison with what everybody else says? Buy term and invest the difference. That's what we're going to talk about, and we're going to get serious about fees. So when I got thinking about fees, it takes me all the way back to when I was a financial advisor. And I spent 16 years as an advisor at different capacities, but I saw all types of fees. But one of the specific fees that I could always see were the fees on investment vehicles like mutual funds, fees on ETFs. So you're familiar with this, right? You all probably invest in 401ks, maybe you've got a Roth IRA, a traditional IRA, or maybe you've just got a brokerage account with your advisor. But how many times do you talk about fees? Well, hold on a second. Most financial advisors that manage money for you, they charge you a management fee, an advisor fee. And usually, and I'm just going to talk about what we used to do at the firm I was at, we would charge anywhere between 0.75 or 0.75% up to as much as 1.5%. Now, does that sound like a lot of money to any of you? Probably doesn't, does it? And some of you are like, well, 1.5 is quite a bit, but 0.75, that's pretty low. But what if it was only 25 basis points, 0.25%? Now that would be a lot better, right? Well, of course it would be. And many of you say,
yeah, that's exactly why I invest in mutual funds
like Vanguard or low-fee Fidelity funds or low-fee BlackRock funds. I'm sure you're very considerate and very observant of fees. But have you ever just thought about it? Have you ever done the math on it? Well, that's what I want to talk about. And what we're going to do, we're going to talk about the fees when it comes down to invest the difference in mutual funds or ETFs versus doing a specially designed whole life, which I'm going to just hit it from surface level. But can I just say one thing? When you talk about a whole life, a specially designed whole life, and the infinite banking concept, it is not invest or buy the whole life, invest or save in the whole life. It is save in the whole life and invest. You can have both with the same dollars. That's one of the most important things. But let's just talk about fees, and don't take me as the expert. We're going to actually go to the SEC, the Securities and Exchange Commission. Because if we're going to talk about fees, let's go to the big dogs. Let's go to the government regulatory agency and let's see what they have to say about fees. Now, folks, everybody watching this video, you can easily find this SEC report. You can read everything I'm going to show you, which is right here. And all you need to do is just go into Google and just type in mutual fund fees explained. Or just go to the SEC, the Securities and Exchange Commission, and punch in fees. And you will see this report. But what does this report do? Well, it explains the truth about fees, of course. Because what the SEC is trying to do is explain to all of you, customers of these mutual fund families or customers of financial advisors, the impact of fees over time. So although you might not think 0.25% is a lot, let me show you what this report shows. You see, it does a little graph. Now, I know you probably can't see this, but actually here, let me just put it right up on the screen. See this chart right here? What it's going to do is it's going to show you over 20 years investing in a mutual fund or an ETF, because really it could be one or the other, where you only pay 0.25% as an annual fee. Now that would be really low. That would be like Vanguard index funds low. So what would be the impact if you put 100,000 in over that time frame? Well, if I go to the back, the blue line represents the investment portfolio of a hypothetical mutual fund that does not charge shareholder fees, so there's no shareholder fees, that produced a 4% annual return, they're just using a level return, over 20 years, and had an operating expense of 0.25. Very low operating expenses. That's $25 for every $10,000 of money that you invest. What would be the impact over 20 years? Any of you want to take a guess? Put it in the comments right now what you think that impact would be. Well, let me tell you what that is. You see, if you invested $100,000 into this fund at 0.25%, that low management fee, you would have a portfolio worth $208,000. But you see, I'm not telling you the impact of the fees, but I will next. So if we did that exact same thing, invested 100 grand over 20 years at 4% flat level return, how much would it be if we increase that management fee to 0.5%? 0.5%. Only 25 basis points more than the first one. What would be the impact? Well, the same dollars over the same time frame would only have grown to $198,000. That means that's an additional $10,000 in management fees just for an extra 0.25. If we were to up the ante and just go up just to 1%, which is about what all the mutual funds are in 401ks as an average, I would guess, probably even more, because now they've got all those freedom date funds and those retirement date funds. Look at your statement. How many of you have retirement date funds in your 401k? I bet all of you do. Those have the highest management fees of just about any fund you will ever get. But let's just get back to that 1%. Remember, we went 25, we went 0.5, and now we're going to talk 1%. So if we did that same thing for 1%, you'd only have $179,000. That's $30,000 more than the previous ones we just talked about. So putting this all into perspective, what this report does is it breaks all this down. It goes through and it explains the type of fees you can expect to pay on mutual funds. And remember, Mr. Dave Ramsey and Susie Orman and so many of the other gurus out there say you shouldn't buy term because term is cheap, even though less than 2% of all term policies ever pay out a death benefit. So really, cheap? Well, I say cost is only an issue in the absence of value. And if you buy life insurance, what's the value? A death benefit when you die, right? So what's the value when less than 2% of all the term policies issued in the country pay out? Well, I say there's very little value in that. But anyway, talking about buy term, invest the difference. The invest the difference, they never talk about the fees on the invest the difference part. That's what I'm doing. Mutual funds carry shareholder fees. They're called sales loads, and there's different kinds. But those sales loads can include redemption fees, exchange fees, account fees, purchase fees, and more fees. But we're not done, because those are just the sales loads. Then you've got the annual fund operating expenses. We haven't even talked about the advisor's management fee. We're just talking about the fund or ETF's fees. You see, the operating expenses are management fees. Okay, those are paid out of fund assets to the fund investment advisor. So now we're going to layer that on top. And how much did I say that was with my firm? Anywhere between 0.75 to 1.5. That's on top of all this other stuff, which would be distribution or 12B1 fees, they're known as, or other expenses like legal and accounting expenses, or total annual operating expenses of the fund. Funds have lots of expenses, which all of you have access to through the prospectus. I mean, come on, you are all reading the prospectus, right? Well, I don't want to bore you with the rest of this stuff. It just goes through and explains all of that. But what I did want to do is just shed some light on the fees that come along with the invest the difference part. But let's get one layer deeper. We just talked about roughly $30,000 over 20 years in just fees for the investments. And the investments probably will fluctuate in value, go up, down, but over a long period of time, you've got a good chance of making money. But now they all say you should never put money into the whole life. And I say, let me give you my perspective. Now, whole life insurance, whether it's designed by us, which would be specially designed and engineered and would reduce the commission by 60 to 90% the way we design it, and you'd pay less in cost of insurance because of the way we design it. But let's just keep it a level playing field. Whole life insurance. What are the fees in a whole life insurance policy? Well, first and foremost, there's a policy service fee. How much is that policy service fee? It's $50 to $100 per year. And those are the companies that we use, $50 to $100 per year. Okay, so that's not too bad, right? But then, what other fees are there? Well, there is a cost of insurance. So in other words, life insurance, whole life or term, has a cost for the insurance portion. Now we already know term is for a term of time, and we know that less than 2% pay out. Whole life is for your whole life. In other words, you can't outlive it. You can't die too soon because it's for your whole life. So clearly, because whole life is for your whole life, the costs are higher, right? Of course, costs in a whole life are more than cost in a term, but cost is only an issue in the absence of value. What is the value of whole life? It pays a death benefit whenever you die. Term insurance, where's the lack of value? It pays a death benefit only if you die within the term of time. Statistically, term insurance, like I said over and over, will pay out less than 2% of all the term policies ever. So therefore, we lack value there, and we have lots of value with whole life, but we're gonna pay for it in terms of a cost of insurance. Now let's go back to buy term, invest the difference. We know there's a lack of value in the term, but there must be a ton of value in the invest the difference portion. Well, there is. Maybe it grows, maybe it doesn't, but we're hoping that it will be worth significantly more in the future. But we have to factor in those fees that I mentioned. Remember that graph from that SEC report. So let me ask you this. If you had to pay fees, would you want to pay the fees to Vanguard and BlackRock and Fidelity? Do you want to give them the fees? Or would you prefer your fees go to pay for a life insurance policy, a cost of insurance on a whole life that will make sure that the day you die, no matter when that is, money goes to your family tax-free? So really there's option A or option B. Give Vanguard, BlackRock, Fidelity, and your financial advisor more money, or take that money and pay for permanent whole life insurance that will pay out whenever you graduate and go to heaven. Option A or option B? Put that down in the chat. But while we're at this putting information down in the chat, may I also ask one more thing? Because I got you thinking now. What I'd like you to do is hit that subscribe button. And when you hit that subscribe button, there's a little bell up top. That was the bell. Sorry, we missed it. Just click it. And once you click it, smash that bell. See how I did an open hand slap? Yeah, that probably would hurt. Well, that's sometimes what I want to do to some of these folks that say buy term, invest the difference is right for everybody, because it is clearly not always the best choice. There's a lesson in filming: you never throw things at the camera. Sorry about that. So now I asked you a really important pointed question. If you had to spend money on something, which would it be? Would it be spend money on making sure your family's protected if you're no longer here, making sure that your family can maintain their lifestyle if they're never here? Or would you prefer to make Vanguard, BlackRock, Fidelity, and your financial advisor wealthier? Because really it is one or the other. So that's up to you. But let's get back to it. What if you could have both? What if you could make sure your family's protected forever, no matter when that is that you graduate and go to heaven, and you could still invest money, you could still lend money on privatemoneyclub.com, you could still take back control of all the money you're giving away for all those credit cards, you could still use it to buy cars, you could use it for everything, because the infinite banking concept is a process. Now, we've only talked about the product of whole life and the product of term and the fees on both, including those side invest the difference funds, which again, if you're coming in late, right here, SEC, just type in mutual fund fees or investment fees and you'll get that report. But I gotta sometimes just put myself in your shoes, and I gotta just think about this logically. Of course I want to make sure my family's protected. Of course I want my family to be okay if I'm not here. Of course I want that money to go to them. And of course, I don't want to make BlackRock, Vanguard, Fidelity, or any of the other funds more money. Back to your financial advisor, you probably don't want to make them more money. I know you like them, I know you trust them, but do you really want them making more and more money? No, you want to make more money. So when we're really thinking about this, we get so hung up on fees, and fees. But I urge you to pay attention to not just the fees and the costs. I urge you to remember, what value do you want? Because cost and fees is only an issue They are only an issue in the absence of the value you're seeking. What value do you seek? Because I'm going to tell you, the value I seek is guarantees, security, and protection, more so than anything else. So when you're out there trying to figure out how to solve your problems, which solution is best, just take it back to the math. Just look at what is it that you're paying for, what are you getting, and does it solve your problem? And if buy term invest the difference is exactly what solves your problem, and you know exactly when you're going to die, so you're going to be one of those less than 2% that the death benefit pays out, I get it. I can't help you. And I'm glad that you went and saw some magic genie in a bottle that could tell you the day you are going to die so that you can beat the actuaries at the insurance companies that also can tell you when you are going to die, and they can tell you you're going to die after the term. So if you die after the term, well, that's great. I've got all this money in those investments. Yeah, because remember, you're supposed to invest the difference. But how much did you pay to invest the difference? Were you actually able to keep all the money in those investment funds? That would require never dipping into it, never going into that money to buy a car, never going into that money to pay off your debts, never using that money. It just sits there and grows in someone else's control, making someone else wealthier and wealthier year over year over year. And not to mention, once that term insurance is gone because you outlived it, now all that money has to self-insure you because you still want to take care of your family, right? Great. So all that money that's in those investments better just sit in those investments until the day you die, so that money then transfers over to your family to make sure they can maintain their standard of living, continue their lifestyle, because you're no longer here. Are you picking up what I'm putting down? You see, sometimes we just need to ask the questions, do the research, and actually look at the mathematics behind what it is we are doing and what it is we are being told to do. Key piece. What are you being told to do? Ask the question. Is it right for your needs and your goals? With that being said, folks, if you like this video, you're going to want to check this one out right here. Is infinite banking a scam? Thanks for joining me. My name's Chris Naugle, and I hope this helped you understand fees, and fees.